Okay, welcome to Kruse Asset Management's quarterly outlook call. Today is total eclipse of the sun day. So we just a couple hours ago, actually 1 hour ago, we just had like almost totality, maybe 98%, something like that here in Chicago. And so we're still wearing our sunglasses. There we go. All right, well, welcome to the call. Today, we're going to be talking about a handful of things, of course, the market outlook, some aspects of virtual family office, and some adjustments that we've been making to our portfolio. So right now, I'm going to start off with comments on the market itself. So any commentary on your eclipse right now, John, while I bring this up?
I was surprised that we had so much light for 94% coverage. I thought it would be a lot darker. Some family members in Ohio had it looked like it was a pitch black at their house.
Yeah, I know. I saw some other videos of people that were like,
that was my biggest takeaway, but definitely fun to see.
yeah, it was pretty bright out. I was actually pretty surprised. Okay, so let's go ahead and share my screen. All right, so here's our KAM quarterly call. And we've talked about this before, but this is a measure of the forward PE ratio, price to earnings index of the S&P 500 as of not too long ago, as of the end of the quarter, so about a week ago. The 30-year average is around 16.6, and that's represented by this line right here. We are one standard deviation and this above that 30-year average. And that's hit above this one standard deviation once during the .com boom. And we all know what happened during the bust and during COVID. So here we are in pretty high ground right now as far as the multiples go and for the marketplace. So we were approaching there in 2022. When we saw this in 2022, we said, hey, we're super expensive. But the difference between that time and this time is at that time, the market looked like it was rolling over, meaning we're losing momentum. We were losing relative strength. That didn't look like we had the gas to continue up. But as you can see in these other two times, the market did continue up and got extremely expensive during the .com boom. So there's no reason why it shouldn't continue to get more expensive in the short term. So, and that's what we see right now. We see momentum to the upward in a very strong way, driven by AI, technology, NVIDIA, a lot of these, the Mag 7, you might call them, all of these companies that are extremely, they're actually a little expensive, but they're driving economic activity and they're driving innovation. But what does this mean? So short term, we can continue to go up. And in fact, history would suggest that we would go up. And that's what momentum suggests, is that we'll continue to go up for a while. Momentum tends to work for 6 to 9, 12 months. The problem with this is, here's the same data. Keep in mind, we're trading at 21 times forward earnings, 21. So keep that number in mind. At 21 times forward earnings, this is a chart of what could happen from that point moving forward. So 21 times earnings, you could get, here we are, 21 times earnings, you could get multiples or next year returns as high as 40, 50%. So there's nothing that says the market is going to sell off right now. In fact, there's quite a few examples that we could see some very aggressive returns. And usually we see some sort of sets of euphoria and some really high expected returns. On the other side, you could see some low numbers, but again, momentum is to the upside. Now, I'm going to contrast this with a 5-year annualized return. And here we are at 21 multiples. And what this suggests is the long-term 5-year average is going to be almost 0. So if we get some huge monster numbers, which we're expecting in 2024 because of the momentum, we should anticipate some big pullbacks as we move along. Any thoughts about that, John? Any comments?
It's very interesting to see these numbers have shifted downwards almost towards 0 from last meeting we had. when the S&P was trading at 19 or something times the end of last quarter. Yeah. Now it's almost down to 0. So a lot of active management you can do to beat the S&P over the next 5 years from here.
Right. So what we were calling for in 2023 was a recession. Almost every economist was calling for a cut in rates. Let me see if I can find, I should have done this. They're calling for almost 6 rate cuts for the federal funds rate. And the market just within the last month or two cut that down to 3, right? I don't think, did I pass this? I think I passed that chart. Anyway, and maybe 2. And Larry Summers, the former Treasury Secretary, said that there's a 15% chance that the next Fed move will be actually a hike. So what we were calling for in the past was, if we saw 6 rate cuts, what we were saying was, if we get 6 rate cuts, that means we're in a recession. You're not going to cut the federal funds reserve rate 6 times without being in a recession. There's just no environment where you're in a strong market and the Fed just cuts rates because they think that's the right thing to do. So the Fed is trying to stave off inflation. And because the market's been so strong, they've now revised, and the market has revised the number of rate cuts to go from 6 to handicap to be under 3. And some economists are saying maybe it's a rate hike in the future, whether it's 25 basis points or what have you. But what that means is the economy's strong, no recession. There's no indicators that are recessionary in the market at all. And the Fed is holding off on the rate cuts because of inflation, right? So they think inflation is going to be stronger or it's stickier than what we thought. So if I go to, John, you want to talk about some of the inflationary numbers? I'm going to go to page 27.
Yeah, sure. I'm a little laggy, so if you can't hear me, shoot me a chat and I'll repeat. I also shared a screen, Stuart. Maybe you can see it, of the projected Fed probabilities for the next meeting of May 1st.
I don't see your screen share. I'd have to take it off. I take mine off.
Okay.
The other screen share. There we go.
Okay, great. There it is. You are sharing my screen. I see it. So just as a small piece of evidence to support what Stuart was saying earlier, on the bottom here, you see now the yellow box showing that first they're holding rates to basically implying 100% odds. But just 1 month ago, that was a 23 to 76%. I guess 24% the lower, 75% cut. So just in 1 month, the implied probability has changed by almost 25%. And a lot of the reason, I guess, Stuart, I can pivot into the inflation data, is because oil in the beginning of the month, or since the beginning of the year, excuse me, has already risen 22%. And crude oil is a huge part of the inflation data, which, Stuart, I'll let you show the JP Morgan slides on that, and I can talk through it. WTI is integrated in all parts of the economy. Obviously, we use it at the pump, but even to produce things, shingles, etc., office supplies, anything you need and consume has oil as part of it. So here, we talked about this last quarter. It's still very shocking that when the peak of inflation was going on last year, you saw the large positive contribution from energy. Energy up, added all that percent to CPI. But ironically, energy is a detractor to CPI at the moment because of how the math works. When you're lapping a year-over-year high number, it's actually taking away from CPI. The last graph I showed had oil up 22%. Doesn't look like it's stopping, and there's a lot of fundamental reasons for it to keep drifting higher. We think this is going to flip back to a positive, and inflation is going to be a risk.
So it looked like it was being driven down. So the Fed's mandate is 2%, right? So it looks like the inflation was being driven down on a linear path. And then right about here, it started to flatten out. So we're still over 3. And now if oil starts to add to this, we might start to get more sticky inflation and actually a rebound.
And a reminder that this doesn't have to be a this year thing. We could easily see CPI kick back up into threes and the fours in a year or two. And that would make the market go into a pretty big panic. If we do see that, it's going to be very hard for the Fed to cut rates. They're going to start raising again, as Stuart indicated, and the market's not going to like that. And when you're at expensive valuations, 22 times, you can't have both. So we're watching it very closely, and I think some of the things we'll pivot to here will show you what we're watching. I think that's the KAM conviction and some of that.
I'm going to bring up, before we move on, I'm going to bring up this inflation rate. And this is what the Fed has in their mind right now. So back in the 70s and 80s, this is what they're worried about. You had inflation come up and it dropped down. And then it spiked here. That spike looks an awful lot like this spike right here. And then it fell off. And it looks like it was under control. And the Fed dropped rates at that point. But then inflation spiked again. And this is about when Volcker took over and then squashed it. So what Powell doesn't want to have happen are these successive pullbacks and rises in inflation where we're fighting this for 15 years. He's trying to fight it just this one time and squish it. So I would say, what, a quarter ago, 2 quarters at least, people were begging Powell to drop interest rates already. And he said, no, we have to keep it higher for longer because, quite frankly, the Fed funds rate wasn't higher than the 2-year, and that's what he needs to have it happen in order to fight inflation. And now we're seeing the stickiness here, which is very similar to this stickiness here. And what he doesn't want to have happen is a jump up in the inflation rate, which again would cause stagflation and cause the market a lot of problems. So this is where we're at on the 2-year Treasury and the Fed funds rate. And Powell needs to keep this 2-year Treasury above the Fed funds rate. I'm sorry, he needs to keep the Fed funds rate above the 2-year Treasury. So here's the Fed funds rate. As long as the Fed funds rate is below the 2-year, this is inflationary. When it gets above the 2-year, it starts to fight inflation. But we're seeing the 2-year rise back up into this. So this is why Powell's saying we need to keep this higher for longer because we still haven't achieved our 2% inflation rate. And he's got to continue to push this down. At the same time, the economy is getting more heated. So that's why some economists are suggesting maybe we even have to raise rates at some point.
And a bull market doesn't help squash inflation. That makes everyone spend more. So that
right,
kind of adds to the fire.
It's 100% right. So what we think is going to happen over the next 5 years, if we're expecting super low S&P long-term returns, you might get some monster returns here and then some really horrific returns later. So tactical analysis and tactical portfolio management is going to be really important. So on to the topic of portfolio management, maybe we'll discuss KAM's tactical or KAM's conviction list. So for close to 20 years, I've been running a QVP, stand for quantitative value portfolio, which is a value portfolio. We'll never have like high growth names in that portfolio. But of course, there's demand for growth. So we've come up with a KAM conviction list that we've been running for a little while now. With the idea being that we just don't need to go strictly after value companies. We want to be investing in companies that have a tailwind. So we have chosen 10 sectors that we think have good tailwinds that will be strong for the next 5 to 10 years. Sectors like AI, cybersecurity, personalized health, blockchain, maybe defense, cloud, those kind of sectors that should be in the crosshairs of higher investments and higher levels of innovation. So as we look and sort through those sectors, we're also going to be looking for companies within those sectors that have accelerated growth and accelerated earnings. And sometimes the stock lags that accelerated growth and earnings. So we're going to be choosing stocks within these 10 sectors that have strong conviction, that have good upward momentum, good relative strength, but also accelerated earnings and growth. John, you want to talk about some more of the specifics behind that?
Sure. All right, I'm going to talk slow and chat me if I freeze. Okay, so the core premise is we want to find stocks that are going to go up and move up in a big way. So obviously everyone knows NVIDIA and some of these other ones, CrowdStrike, right? You can see these very defined uptrends. And so there's a lot behind just picking a stock. We are starting to really lean into, or I'm starting to really lean into, I don't want to put words in Stuart's mouth, but the fundamentals and the actual. So let me start with one example. This is Okta, and this chart, I'll take a minute to explain it. It's 3 years, and the purple is the stock. The green is revenue, trailing 12 months revenue. The blue is the annual earnings, and
The orange is diluted earnings per share.
that's adjusted, non-GAAP. What is this? Orange is trailing 12 months, but non-dilutive or non-adjusted. It's diluted EPS. So we're looking at the fundamentals and the slope of the fundamentals of many different stocks. Can you hear me okay still?
Yep.
Okay. So I loaded up a few to screen through, and I would like to show some of what we look at with the earnings here and then the charts. And we try to mirror the two to pick some of the best stocks to be with, as Stuart mentioned earlier. So
looking
this
at this
stock,
chart, looks like we had
Okta, revenue.
and then an acceleration, like a point, an inflection point in earnings per share, an acceleration of revenue, and a turn up of annual earnings per share as well, without the commensurate
Right.
stock increase.
Right. That's exactly right. Everything up and to the right, stock has okay. Check out the earnings, revenue, and the other pair of earnings straight up and to the right. CrowdStrike, cybersecurity name. Revenue up, adjusted earnings up and to the right. And you see this acceleration picking up in the earnings. And another important factor is the earnings have gone from negative to positive, which is a inflection point for companies. I go to one of my favorites right now, Square. You get the gist. The earnings have inflected higher. Your revenue has been going up. Your earnings have been going up. And I'll take a minute here to pivot back to a chart to show why this is so impressive for Square. When you have all this moving up and to the right, this is GAAP earnings, this is adjusted earnings, and it's revenue. Yet the stock price has been basing for almost 2 years. Let me flick to that. When we look at the chart of Square, we already know that the fundamentals are pointing in the right direction. But take a look at this. It kind of looks like the stock has been basing for so long. And the next big move, you got an inverse handle, you got a big bull here. There's all the different ways you can shape it. You got resistance breaking through bouncing numerous times, going to break through. So we can realistically say Square right now is a great buy because we don't know when it's going to pop. But when it does, it probably sees 120 pretty quick because we know we have a lot of earnings behind it and a lot of revenue behind it. And another thing we do is we also look at the projected earnings going forward 1 to 2 years, and we look at the acceleration of those earnings. So we know that the earnings going forward look good as well. So I'll just look through a couple more here. We just put Micron in the portfolio. This is a little bit different. You can see the chart was kind of making a bull feature here, but most importantly, you see this inflection point on the earnings, where the earnings and the revenue took a nice move higher, and on that earnings report, you saw the stock react tremendously, up almost 20%. One more, and then I'll pivot back to Stuart here. Kopang, it's the Amazon of South Korea. Revenue up and to the right, and you can actually see the revenue almost accelerating at a faster pace right here with the slope of that line. Same thing with trailing 12 months early earnings, and your adjusted EPS up. You got the same bull. You got the same stock price not reacting as well, which is good because we know the earnings are up. Now we're just waiting for the stock price to move. Maybe we see a nice 100% move over the next couple of years. Obviously, nothing guaranteed, but just look at this chart. I mean, do you think this chart could get back here? I do. So we place our bets, and you know, we hope the market does the rest. So stop sharing. Stuart, back to you.
Yeah. All right, so that's our KAM conviction list. And then we want to reiterate that we're really full into our virtual family office. So for those who are not familiar with what a virtual family office is, the family office concept was invented by the Rockefellers. It's obviously extremely wealthy family. They incorporated a team of financial professionals, financial advisors, private equity, estate planners, CPA, to work on their money to optimize their wealth on their behalf, right? But most people don't have the 500 million or $1 billion that would take to have that kind of payroll on full time, but they also might need some of those services some of the time. And you certainly would love to have your advisors working together. You'd want your CPA working with your financial advisor, working with your estate planning lawyer, working with somebody who's giving you tax mitigation strategies and any kind of opportunities. Somebody's trying to help you buy and sell your business. You want everybody working together. And that's what this virtual family office is all about. So it really comes in 5 areas: risk mitigation, wealth management, legal services, business advisory, and tax planning. So just to show you, here are some of the experts that we have, and it just gives you an idea of the depth that we have of people that can be working on your behalf. And that we're all committed to a team-based approach of optimizing your wealth. That's what a virtual family office is. We virtually have a family office for you when you need it. And then when you don't need it, you don't have the expense. So that's the idea. Now, I will say that the vast majority of people are looking for tax mitigation strategies. And we were able to help our clients literally save millions of dollars last year in tax mitigation strategies. So, we have gone a little deeper into that area. We have purchased software called CoreV, which is a automated software that helps take apart your tax returns. So your CPA generally will do your tax returns. They take the data in, they fill out the paperwork, and then they report what you owe to the IRS and report all that stuff. But they often don't give you proactive tax mitigation strategies. This is what we're trying to flip with the virtual family office. We're trying to work with your CPAs and other CPAs so that they are much more proactive. So this software that we use will take in your tax returns and then give suggestions for some proactive tax mitigation strategies for you. So if you paid $50,000 or $100,000 and up in taxes, this is ideal for you. So we think we can really reduce this by stacking multiple strategies on top of each other to help bring your tax liabilities down to a very low number, while still either giving to charity, getting money back to you and your estate, or creating an investment opportunity for you down the road. So it's not just not like, hey, I'm going to take money and give it to a charity, and then all of a sudden I get a tax deduction. That is a possibility, but we have dozens of strategies that can be somewhat delayed gratification for you down the road, but still have a tax deduction in the current year. So with that said, what we want to do is, I know it's tax season right now. You file your taxes in 7 days. I'm sure your CPA is pulling his hair out right now, or her hair out right now. But after tax season, we're going to want to and request your tax returns so that we can, as part of our services, part of our virtual family office for you, run it through this software, come up with tax mitigation strategies for you 2024, and then we'll approach some of these in a little bit more aggressive fashion towards the end of the year, once we have a good handle on how much you've made, what your full picture looks like, and where we can really add the most value. Thoughts on that?
Thoughts are just that there's a tremendous amount of things we can do. And looking at this list, it's not even half of the list of just the family office. There you go. On the asset management side, we have equal amounts of, I guess not equal amounts, but we feel that just as confident in our portfolio management. And if we do have the 0% S&P return for 5 years, we have a slew of alternatives and other strategies that we think will materially outperform. Besides that, we are watching every day and trying to get better. And KAM conviction and charting and fundamental analysis is all part of it. So that's all I have to say.
Yeah.
Solar eclipse was a dud.
Yeah, we're coming up on half an hour. So in summary, there's no signs for a recession, although we've had the longest inverted yield curve that we've had in the last 50 years. That could, again, still suggest that there would be a recession coming. It just, from inception to recession, oftentimes it can be, we've seen 2-year lags from when this has happened. So that would take us to the end of next year or the end of this coming year. So we're still not out of that inverted yield curve window, but there's no indicators that suggest there's a recession. And in fact, we see market momentum to the upside. So we're staying fully invested right now. But we have an eye on the fact that the long-term 5-year returns are probably going to be pretty lackluster. So we're going to be using a lot of tactical allocation, getting in and out of asset classes as they start to lose momentum. Will definitely be, it's not going to be just a buy and hold strategy. Come the second half of the year, we're going to want to really get into some tax mitigation strategies, because hopefully you're going to be making a lot of money in 2024. We're going to be probably having to sell off some securities because we're going to want to capture that gain. We're not going to want to ride it all the way down and end up with 0% returns. And so we're going to need some tax mitigation strategies. So we'll be importing some of that software, working with your CPA in conjunction with our family office to help, not just how much you make, but how much you keep. So help you keep more of what you make. Okay.
Sounds great.
So that's our market outlook for 2024. Heading into Q2. Can't believe it's already Q2 in that total eclipse. So we are, as John likes to say a lot, onward and upward. And Kruse Asset Management just hit a big milestone that we celebrated. So we've doubled our firm in the last 3 years. I'm sorry, excuse me. So that was pretty important. So I think that goes to showing how much of a success this family office has been and how much value add we've been able to add to the clients and working with partners. So we're looking forward to continually service you as best we can as a fiduciary, and continue to provide these market updates and hopefully add value to both your investment side as well as your tax side. So we appreciate you watching. From myself, Stuart Kruse, and John Brick, thank you so much for the trust you've placed in us, and we will work hard to continue to be worthy of that trust.